Bhatia joins us. Let's take our conversation forward. He is CIO with ITI Mutual Fund. Rajesh, good morning. Thank you for joining us. What do you make of the current market uptrend? Do you think the liquidity-driven market will remain intact longer than what everybody is anticipating? Do you think it's a force of liquidity which is making all the difference and will continue to make all the difference?
Actually, I would like to believe that this is the best kind of bull market that you can get. So India is experiencing a structural bull market. How do we know that is the best bull market? Because look at the breadth of sectors that are participating, right? And that's not what makes this bull market unique and extremely strong. Autos, banks, life insurance, general insurance, domestic pharma, telecommunications, capital goods, utilities, everything is participating. That's the best kind of bull market that you can actually get. So I think the bull market has very, very strong foundations. We are at a late stage of a valuation cycle. As you point out, there is excessive enthusiasm, particularly probably in the mid cap and small cap spaces. But you must know that we are at an early stage of an economic cycle. Translation, we are going to be, this is a capex driven cycle. And there is good visibility that that capital expenditure will happen over the next 3, 5, 7 years, whether it's power, transmission, distribution, real estate, railways, roads, etc. So the macros are very strong. It's an early stage of an economic cycle. So I would say that the bull market has very good foundations why you're seeing this kind of enthusiasm and why liquidity is kind of following suit.
So what should be the strategy in this kind of a market when valuations are in late cycle and business is in early cycle?
Yeah, stay invested. I mean, so we are also looking for a reason why the market should correct. But given the strong macro, given the fact that interest rates are kind of coming down globally, which is supportive for equities, given that while there was first quarter trepidation on earnings, a country which is growing at 7 or 8% GDP should not have an earnings trajectory challenge as you move forward. So we are also looking for one risk that can disproportionately impact the equity markets, but we are not finding one. So maybe there can be a technical correction along the way, but it's very difficult to time that technical correction. We are also looking for reasons. So what's the second best alternative? Just stay invested.
Yeah, absolutely. But Rajesh, would you put fresh money to work at this juncture? Because, each time that you think that valuations are getting frothy, the stocks move up another 20% from even those levels, right? So it's pretty much like an unstoppable market. And there's just so much appetite at any given dip or even a moment of consolidation, if you will.
So never underestimate a bull market. They will surprise you, more than what you can expect, right? As far as valuations and comfort of where to invest is concerned, see, if you look at the larger caps, the Nifty, if you just move to financial year 26 earnings, it's quoting at about 19 or 20 times. Our 10-year average of Nifty valuations is at about 17 times. I wouldn't call that particularly expensive given the context I just spoke about. So I would say the large caps are certainly a place where there is value. And that's really where one should be. Having said that, the India growth story, we are the fastest growing economy in the world. We are the most predictable story in the world. If anybody had to take a call, what market is going to do 3 times, 5 times over the next 10, 20 years, a lot of people would point to India. But who's capturing that best India opportunity? It's actually mid-cap and small-cap companies. So the growth rates of mid-cap and small-cap companies, defense, electronic manufacturing services, all of that, capital goods, engineering exports, all of that is really in the mid-cap and small-cap space and where the growth rates are much faster. So at this moment, there is value in large caps. There is not as much value in mid-caps and small caps, but please don't forget that the India growth story is really panning out in the mid-cap and small-cap sectors.
Okay, Rajesh. But is there any space that you would recommend booking profit out of or trimming positions, or is it a buy all kind of scenario right now?
Well, it's not been very easy to call out a topping of a sector, if you ask me. But consumption has really been a very weak pocket. And this is, like I said, it's a capital expenditures cycle rather than a consumption driven cycle. So if you look at our history, 2003 to 2008, we were a capital expenditure driven cycle. Not that consumption was not strong at that time, but the dominant theme was capital expenditure. From 2009 to 2020, I would say it was a consumption driven cycle and capital expenditure just collapsed. And for the last 2 or 3 years, again, it's a capital expenditure driven cycle. So my sense is that that's really where the energy is, that's where the earnings energy is, and the visibility is. The visibility is quite low as far as consumption staples, etc., is concerned.
I'll send him an email. What do you make of IT? Because that's where I think the hope is that the turn is around the corner.
Yeah. So basically, if you look at the context, IT peaked when the demand was very strong, but it peaked in March 22 when interest rates in America started to go up, right? And the corollary is probably playing out or wants to play out when, as soon as we have sense that the US interest rates can actually come down, the market is assuming that the growth rates, I know that there are a lot of analysts pointing out that there is no visibility of growth at this moment. But the bet that the market is taking is that growth rates have bottomed out. So as you move forward into the next 12, 18 months, IT growth rates will kind of come back with the peaking out of interest rates, which will become a tailwind for the American economy. And mind you, we're at this moment assuming there is no hard landing in America. It's a soft landing. And given that's the assumption, that's the narrative, if that's the case, then the assumption of the market is that with interest rates peaking and coming down, growth rates of IT companies will kind of improve. And by the way, these are fantastic companies. They are very high free cash flow, high dividend companies. So that's again, and given the context of where the markets are, I wouldn't call them extremely expensive.
Okay. Rajesh, let's also look at the most popular PSU space, defense and railways. What is the right way of looking at it?
Expensive. In one word, expensive. But I would say that there has been a structural shift in how the defense and railway companies, the railway capex has gone up 10 times in the last few years. And I think the narrative on defense is that you'd have to indigenize, you'd have to stop imports. Not only that, you have targets for exports. So my sense is that, and then there is a very steady, the need, given the global context and given the geopolitical considerations, we will need to step up capital expenditure as far as defense is concerned. So, and there is a preference for domestic companies. So my sense is that this is a narrative which is going to be a multi-year narrative, but I think the valuations are definitely not comfortable at this moment.
Rajesh, the other point, of course, is, what to avoid in this market. Pretty much an extension of what Anisha was just talking about, wherein would you be tempted to book profits? But are there spaces where you think that valuations as well as growth both have peaked out?
Like I pointed out, it's very difficult to kind of call out which has peaked out. You can identify areas of weakness. But look, India is such a fantastic market, right? You can have as a fund manager, I can have a breadth of sectors in my portfolio, find winning companies in the portfolio, and I'm done. It's so simple. Unlike America, let us say, the Magnificent Seven are doing well on one narrative, which is artificial intelligence, right? And you don't know, how far to extend that narrative. India, on the other hand, there are many, many sectors to play. If ever there has to be some caution that I would kind of play is if is capital marketplace. With the capital marketplace, what your assumption is that growth rates will continue, that growth rates are subject to markets. So what analysts are tending to do is saying, there's going to be a 30% growth rate for the next 2 years, and I'm going to incorporate that, and on that, I'm going to give a higher P, right? By the way, these are highly cyclical businesses and high beta. What I mean by that is, God forbid, if ever there is a correction in the markets or if there is a decline, that 30% increase assumption actually becomes a decrease assumption, and your P's contract. So there, the capital marketplace actually is high beta, and I think that assumption is a little stretched as far as I'm concerned.
Okay, what's the view on pharma though? Because of late there has been, increased favor towards that because that was one of the underdogs per se. Is there merit in looking at that?
Well, domestic pharma companies are really compounding machines. I mean, they have done extremely well. So I would say that yes, domestic pharma it's like a branded consumer company, and some of these companies have done extremely well. As far as the global facing companies are concerned, it's difficult to call out generic cycles. So my preference is to bet on companies which are growing their specialty business. So that's where the moat is created. That's where the multi-year visibility and fat margins are created. So I would want to bet on for global markets, companies which are creating these products which will have fat moats and fat margins.
So let's look at a theme which in a sense has been a very popular theme, couple of themes, and I'll seek your opinion on that. EVs, EMS, manufacturing. These stocks are now trading at P multiples which are higher than consumer, and their margins are 12-13%. Their ROS is not that great. What's happening in this space? Excitement, euphoria, or betting on a future which markets are seeing right now? Results will prove after 3 years.
So in bull markets, the vision of investors becomes longer, and in a bear market, the vision of the investor is shorter and shorter. So we are in a bull market. So clearly, I think people are kind of seeing in a more distant future. See, as far as electric vehicles are concerned, I think from point A to point B, the direction is clear. I think we are going to move to electric vehicles. I was reading a very interesting article in Fortune on Volkswagen, which has been late. By the way, that's the largest automobile company in the world, which has been late to EV party, but they're committed to EV. They're saying that that's inevitable because costs of electric vehicles will kind of move down, over a period of time, and costs of ICE engine vehicles is going to move up. So I think the economics are going to move in favor of EV rather than ICE. Now, the challenge is what happens in between. Like as Bill Gates says, with technology, we overestimate what technology absorption is going to be in the short term, but underestimate it in the long term. I think we are in the process of probably overestimating how much of this is going to happen in the short term, although I think the direction is clear. I can elaborate on that, but basically the point is that with electric vehicles, there's a lot of things yet to happen. Even in the two-wheeler space, the market that electric vehicle two-wheelers has got is about what? 7%. And that's two-wheeler is not a very fast-growing market in India. It's already a highly penetrated sector. So the absorption there is about 7%. So maybe there's a lot of forecasting that is taking place with this business, but a lot of things have yet to pan out. How will the subsidies pan out? What rate will your costs come down? What rate will consumers start accepting this product given range anxiety, etc., etc. So there are a lot of things yet to pan out. But like I said, from point A to point B, I think it's clear that electric vehicles will be a dominant play as you move forward.
Rajesh, on that note, we'll let you go. Thanks so much for making time and speaking with us.
If you like this video, then like, share and subscribe to ET Now.